I'm assuming we're now live, Susan, if you just want to give me a thumbs up. Very good. Morning, everyone, and welcome to this Future Influencers webinar, which I think is our inaugural one in terms of using this technology for reasons that we're all aware of. But hopefully we can get the same from this session that we would do meeting face to face. I'm John Wilson, Head of Technical here at Spence, and I'm joined by Emer from Spence as well, and also Kevin from Deloitte will be joining us shortly as well. A bit of a mixed bag, but to begin with, what we're looking at is the measures of price inflation that are used for pension increases, and in particular the debate around whether pensions should be increased in line with RPI or with CPI. Both myself and Emer will be looking at that. And then when Kevin from Deloitte joins us, he is going to update us from an investment perspective. But more of that later. We'll get right into this at the moment because there's a lot to cover. So if you could move on to the next slide, please. All right, so as I alluded to already, what I'm going to be looking at is the increases to benefits that apply in schemes, giving you a little bit of background to that in terms of setting the scene and why it's so important. And then I'm going to hand over to Emer, who is going to look at the current ongoing government consultation around the measure of price inflation used for pension increases and the proposals for change there, which could potentially be fundamental. And a bit of my talk is that we have had a number of cases recently where employers have effectively tried to get the benefit of the proposed changes in the consultation now, and their attempts have been met with varying degrees of success. But let me set the scene first in terms of increases in pension schemes and their benefits and why they are so important. Because there have not always been legal requirements to provide for increases or inflation proofing in terms of pensions and other benefits, either in deferment or in revaluation. So just a quick recap by way of background to this. So in terms of benefits attributable to pensionable service before the 6th of April 1998, there was no statutory requirement to increase pensions, and that included guaranteed minimum pensions from contracting out. Things changed between April 1988 and April 1997, when pension schemes had some responsibility for increasing guaranteed minimum pensions in payment by the lesser of RPI and 3%. And then requirements around excess benefits were introduced from 6 April 1997, where benefits had to be increased by 5% LPI, limited pricing. I'll explain what I mean by that in a second. And it was 5% LPI, and then up to April 2005, and then from 6th of April 2005, the 2.5% LPI became a replacement for the 5% LPI. And what I mean by 5% LPI and from 2005, 2.5% LPI is benefits had to increase in payment up to 5%, capped dependent on originally the retail prices index. Then benefits had to increase in line with the retail prices index up to 2.5%, and RPI was historically used as the measure of inflation under the LPI calculation, but in 2011 CPI was used. But the exact impact of that on pension scheme was actually highly dependent on the pension scheme rules, which I'll come on to. So just for completeness, all the increases that I've covered there, both in terms of the guaranteed minimum pension and the excess above guaranteed minimum pensions for increases to pensions once they come into payment, was around defined benefit pension schemes. There were requirements around money purchase pension schemes for protected rights from previously contracting out. And there was a period, in fact, for excess rights to increase in line as well with limited price indexation, but that requirement was repealed. And also because protected rights and money purchase pension schemes have been repealed from 2012, there are essentially no statutory increase requirements for benefits and payment under money purchase schemes. So the statutory requirements that we are covering in this case are confined to defined benefit pension schemes. So just getting back to the background or scene setting I was doing there, I was saying that the legal or statutory requirements for pension schemes to increase benefits once they are in payment to protect them from the effects of inflation is something that has not always been around. It was introduced in respect of contracted out benefits in the 1980s, then introduced in respect of excess benefits above contracted out benefits in the 1990s, and in particular under the Pensions Act 1995 from the 6th of April 1997. But that does not mean that prior to these statutory requirements, pension schemes did not increase benefits, both in deferment and also in payment. They did, but it was a matter of scheme design. So it depended on what was in the scheme rules. And some scheme rules because defined benefit pension schemes, were set up sometimes 40, 50 years ago, actually contain some quite generous increases. For some pension schemes set up in the 1970s, where there were periods of high inflation, it was not uncommon to find hard-coded, i.e. explicitly stated in the pension scheme rules, that benefits once in payment, and sometimes also in deferment, would increase at minimum rates of things like 5% per annum compound. So these scheme level provisions in the scheme rules were part of the scheme design and could only be amended in line with scheme rules as well, the scheme amendment rule, and more recently some of the overriding legislation that we have around scheme modifications. I'm talking here in particular, of course, about Section 67 of the Pensions Act. And if we could move on to the next slide, please. So because of the situation that we have is that going back to before 1988, increases were dependent on scheme rules. From 1988, increases were dependent on scheme rules and the contracting out requirements. And from 1997, increases were dependent on scheme rules, contracting out requirements, and also the provisions of the Pensions Act 1995 as it was subsequently amended. You had this position which effectively created for many, many pension schemes a bit of a pension schemes rules lottery. So, for example, in 2011, when the government changed the measure of price inflation for pension increases from the retail prices index to the consumer prices index, that meant straight away public sector pensions and state pensions started to increase in line with CPI and not RPI. But that change did not automatically apply to all private sector pension schemes. It depended entirely on what the scheme rules had said. And because originally the measure of price inflation was RPI, a lot of scheme rules still specifically referred to RPI in scheme provisions as the measure that would be used for increasing benefits. Revaluation tended to be a bit less affected because a lot of scheme rules just referred to the legislation. So RPI became CPI when the legislation was changed. But just the way that scheme rules were drafted, when it came to increasing pensions in payment, many scheme rules specifically said that your pension and payment will be increased in line with RPI, either capped at 5 or capped at 2.5, or maybe something else. So RPI was specifically referenced. So when the legislation changing RPI to CPI came into force, it did not change what the provisions of the scheme actually said. So if a scheme wanted to move from RPI to CPI, it depended on interpretation of the rules and possibly changes being made to the rules. And if a change to the rules was needed, then the change could really only take effect for benefits of pensionable service on or after the change, which would limit the financial impact of making a move from RPI to CPI. Now, as a result of that, what we were left with was a position where about 3/4 of defined benefit pension schemes, still about 5,000 in existence, remember, still had some kind of reference to RPI or retail prices index in their rules. And a lot of debate began amongst trustees and employers and their advisors around how the pension increase could be interpreted. So in particular, where there was a reference to retail prices index, then depending on how that was defined, there was a lot of negotiations between various parties as to whether or not the pension scheme increase provision could be interpreted as allowing a move from RPI to CPI, either automatically or with the agreement of the trustees and or employers. And essentially what companies in particular were trying to achieve was to get the benefit of the change from RPI to CPI in 2011 as it impacted on public sector schemes and also state pensions. So from a particular date, all benefits, even those already in payment, would start to increase in future with CPI and RPI, with CPI on the whole, of course, being a little bit lower than RPI, meaning that there's a positive impact on the scheme's financial position for those that are able to make the change in terms of the pension increase index. And what we have here is the key cases that have come before the courts, some just at High Court level, some at Court of Appeal level, and one of them at least, the Bernardo's case, went all the way to the Supreme Court. These were a result of either confusion or disagreement between trustees and employers as to how pensions in payment should increase, where quite often the employer was arguing that the rules allowed a move to CPI, and the trustees either not being sure or the trustees saying that they still felt the rules required the more generous RPI measure of price inflation to be used. And what I can say is about the 9 cases there, and there are also some separate ombudsman determinations, only 2 out of the 9 have managed to successfully argue that the scheme rules were wide enough to allow a change from RPI to CPI for all benefits in the future. So the 7 other cases were dismissed either at High Court level or on appeal at the Court of Appeal. And quite often, a lot of the cases centred around the fact that you would have a scheme rule that said that pensions and payment will increase in line with the retail prices index, or if the retail prices index is ever replaced, then another suitable index agreed by the trustees and or employer. Or pensions and payment will increase in line with the retail prices index, or if RPI becomes inappropriate, then in line with another index as agreed by the trustees and or employer. And the cases that were dismissed, which as I've already mentioned, was most of these cases, 7 out of the 9 on that slide, were because when this came before the court said no, RPI might have been criticised, RPI maybe has been undermined as a measure of price inflation, but as at today's date, the retail prices index still exists. It's still needed for the purposes of gilts. And no official authority, the authority responsible for publishing the retail prices index, has said that it is now inappropriate and should no longer be used. So for these schemes trying to argue unsuccessfully that they should get a move to CPI, they were unable to do so while RPI still existed and while RPI had not yet been declared inappropriate. And these cases have gone on for about a period of 8 years now. The Kinetic case, the first one on that slide, was 2012, and the most recent one, Arup, the decision was just handed down just last month. Curiously, Kinetic was successful in a change, as was Arcadia, and it's all the other ones from about 2014 onwards that have been unsuccessful. So these cases, and there's probably more in the pipeline, are left in a position really that either they can only change to RPI for benefits attributable to future service, which might not help in a scheme closed to future accrual, or they are stuck with the retail prices index as the measure of price inflation for increasing pensions and payment until such time as RPI is officially replaced or is officially declared to be an inappropriate index for the purpose of increasing benefits under pension schemes. And that really takes us on to where I'm going to hand over to Amir, because we are now in a position where that requirement for something fundamental to happen to RPI before pension schemes are being able to move away from RPI as their measure of price inflation. And remember, it's still 3/4 of the DB universe. That could happen, but it might not happen for a good while yet. And Amir will explain a bit more about what I mean about that and the timescale for any fundamental change. And I think, Susan, I'm going to hand over to Amir at this point.
Thanks, John. Hi, everyone. My name is Emer Maguire. I'm an actuary working with Spence & Partners. I'm hoping everyone can hear me okay, but just pop it in the chat if you have any issues. So I'm usually based in the Belfast office, but obviously working remotely at the moment due to the COVID situation. It would have been lovely to meet everyone in person, but it has to be virtually at the moment, but I hope everyone's keeping safe and well. So as John mentioned, I'm going to spend the next 10 or 15 minutes talking about the government's recent consultation on RPI and CPIH, which I know many of you will probably have seen or at least heard of. The consultation was launched on the 11th of March and is running until the 21st of August, with the deadline being extended due to the COVID-19 crisis. So hopefully you all find this presentation useful, and if you have any questions, we can pick them up at the end of the presentations. So just to run through a quick agenda for my talk this morning. So my session we'll first look at the basics. So what are the different inflation measures, just to recap. We'll then look at the relationship between RPI, CPI and CPIH. The key themes arising from the government's consultation, along with different views and limitations around the use of RPI and how that might change. We'll then look at possible consequences for pension schemes and some potential actions that pension schemes can take. And then we'll just have a summary of the consultation questions at the end. So now if we look at the basics slide, so this slide essentially sets out, just as a recap, the three different inflation measures. So we have the retail price index, consumer price index, and CPIH, which is the consumer price index, which includes owner-occupiers' housing costs. So the ONS publishes these inflation measures, and it has its role for official statistics for the government. So RPI was formally introduced way back in 1956, and it's the oldest measure of inflation still published by the ONS. It does have a range of shortcomings, which we'll look at a wee bit later on, and lost its national status in 2013. But it is still a widely used measure by the government, although its uses have reduced. And an interesting point is that the longest index-linked gilt currently offered by the UK government extends right up to 2068. So CPI was introduced in 1997, and the government set it as its inflation target in 2003. And it uses the same basic price data as the RPI, but there are some differences. For example, CPI doesn't include housing costs, savings and investments, or charges for credit. It covers a broader population than the RPI, and it has different classifications for goods and services. And then CPIH was brought in 2010, and is the measured rate, RPI inflation is around on average 1% above CPIH. With that effect of that 1%, 0.7% of that is basically attributable to clothing prices, which account for about 0.4% of the formula effect since 2010. So now if we move on to the next slide. So over the 5 years from January 14 to June 2019, the 12-month growth in the CPIH has on average been about 0.9 percentage points lower than the 12-month growth in the CPI. So we can see from the graph the relationship between this RPI, CPI and CPIH over the last, say, 12 years. So you see the CPI in blue, CPIH in red, and the RPI, the yellow line. So there's some conceptual differences. So the historical context, as we've touched on, are a bit different. So RPI replaced the cost of living index, and it was there to assist and protect ordinary workers from price increases due to World War I. And RPI uses more up-to-date expenditure data and has a broader coverage. And as we've touched on, CPIH measures the change in a price of goods and services consumed by households. And there's also some differences in methodology. So the basic approach to RPI and CPI are the same. They both track the change in this fixed basket of goods and services over time by combining around 180,000 individual prices for 700 different items. But there are differences between the measures due to coverage, population base, and the way in which individual prices are combined at the first stage of aggregation. So now if we move on to the next slide, we'll touch on some key themes from the consultation. So when reading through the consultation, what struck me is the overwhelming negative views expressed on RPI. So the government and UK Statistics Authority are at the moment consulting on how they will align RPI with CPIH. There appears to be no doubt that it will be aligned, and from 2030, the UK Statistics Authority will be able to make this change to RPI without actually seeking the consent of the Chancellor. So the consultation suggests this direct alignment, and after a year for the mathematical effect to come through, like a transition period, RPI and CPIH will be expected to emerge as the same. So CPIH, as we've said, is an average about 1% lower than RPI. The actual impact on defined benefit pension schemes will depend on the extent to which the benefits, the liabilities are RPI linked. CPI benefits should remain unchanged. However, a lot of the time actuaries will set their CPI inflation assumption as an offset or a deduction from your RPI assumption, so it could have an impact there. And the impact on funding will depend on your level of RPI and CPI hedging. And there are different views in the sector about the extent to which this consultation and this proposed change from RPI to CPIH is actually already reflected in the market and in the market's expectation of inflation. So now if we move on to the next slide. So yeah, a bit of a corny title, but is it RIP to RPI? So there's significant value to users of RPI remaining, and that's about the only positive point expressed in the consultation by the then national statistician. But the then national statistician then went on to say that RPI does not meet international standards, went on to say that it's a poor measure of general inflation, which at times overestimated and other times underestimating inflation. And the Johnson Review in 2015 expressed that RPI should be considered a legacy measure to be used only where contractually required. It also said that no further changes should be made to RPI and that over the long term it should be gradually phased out. And the Johnson Review also went on to say that it was a flawed statistical measure of inflation to use RPI. With the House of Lords Economics Affairs Committee going on to say that by not fixing the RPI, that it was failing in a statutory duty to promote and safeguard the quality of official statistics. So the views on RPI are extremely negative, but there are some positives, and some of those positives are the RPI is used widely in the economy, and the impacts on these wider uses from the proposal being implemented are likely to fall outside the factors that the Chancellor will be considering in its decision. But some of the positive wider uses, or RPI is used, for instance, in rail fares, industry costs, interest in student loans, and in some wage bargaining agreements, and has some wider uses in the financial markets, which the government has asked for some detail on, just so in case it's not doesn't have full visibility of all of RPI's uses in the financial markets. So now if we move on to the next slide. So how will RPI change as a result of the consultation? So the proposal is that RPI index values would be calculated using the same methods and data sources that are used for CPIH, and the consultation suggests a chain link statistical approach, but does pose the question, is this statistically rigorous? So essentially that the growth in the new series under the new methodology is applied to the long run series on the old methodology. So this approach is widely used internationally for introducing new methods, new basket items and new expenditure weights to ensure that the index reflects consumer preferences. So in the RPI, such updates are made annually for the February index published in March, and the authority therefore proposed to use this chain link approach to introduce the methods and the data sources of the CPIH as the more robust statistic. So RPI series includes index values and monthly and annual growth rates, all of which have different uses. It's not possible to implement the proposal across all three rates at the same time and achieve this consistent set of measures. So to calculate annual growth rates, as we said, index values are required for 2 years. And during the first year of transition, the annual growth rate calculation will be based on the previous year's RPI and the current year's CPIH, making the annual growth rates for the newly calculated RPI and CPIH inconsistent. So this will be done with the February index of the implementation year in line with regular RPI updating procedures. So essentially the timing for implementing such a proposal is open to discussion. The consultation mentions that the then Chancellor is unable to consent earlier than February 2025 based on the information available. So the consultation does go into some detail about this statistical approach, which is worth a read, and sets it out step by step along with details of the proposal from the government, but it does pose the question, is it statistically rigorous? So essentially, the Chancellor must take into account the impact of the authority's proposed change to RPI on the interests of index-linked gilt holders, any potential impacts on that market as a whole, any potential impacts, say, to the government's public finances of such a change. For example, will the government decide to postpone this RPI CPIH debate further due to everything with COVID-19 at the moment? But I think, as John alluded to, it's definitely going to be a significant pensions debate over the next few years. So now if we move on to the next slide, we'll consider a little bit, so focusing on defined pension schemes specifically. we look at the possible implications for pension schemes on the next slide. So basically, the government would need, we're looking at assets, liabilities, and scheme funding. So the implications for pension schemes will on your assets will depend on the extent to which RPI, the extent to which your benefits are RPI linked, and the movement will have a negative effect. And on the assets, if it's CPI linked, there'll be no expected impact. However, on the liabilities, if RPI linked, the cost would be expected to reduce, and that would depend on the extent to which your benefits are inflation linked. And if CPI linked, the cost would be expected to increase if the assumption is set as a deduction to RPI. I'm not sure if everyone's able to see the next slide on the implications for pension schemes. It's not showing up. Thanks, Caroline. And then just with regards to scheme funding, this depends on the level of hedging and the extent of RPI CPI benefit linkage versus fixed. So essentially, beyond these impacts, there are several further effects of the authority's proposal on the holders of index-linked gilts and the gilt market, indeed more broadly. So in the document, it touches on that many index-linked gilt holders will hold such gilts to hedge RPI-linked liabilities. And so therefore, a change to the methodology for the RPI will affect both the assets and the liabilities of the gilt holders. The net effect, so as we've touched on there, we've looked at the impact on your assets and the impact on your liability. So there'll be some funding level risk there in that the net effect on the investor's balance sheet is uncertain in aggregate, and will also vary for each individual investor, not just looking at pension schemes. But these changes to investors' balance sheet may affect their future demand for gilts and wider spending and investment decisions, which could in turn impact upon public finances. And the consultation is also looking for information on the impact of such index-linked gilt holders and the indirect effects on the gilt market. So now if we move on to the next slide, we look at some of the potential actions that pension schemes could consider at the moment. So the pension schemes should look to assess levels of inflation hedging, consider the consultation perhaps when looking at inflation assumptions, might want to consider holding an inflation reserve for valuations to account for that. Understand the impact on a scheme specific level, as we touched on the previous slide, and also considering the actual direct impact on members, especially from a trustee perspective. So the different measures of inflation and how they would typically impact pension schemes. So both statutory in-payment pension increases and revaluation prior to retirement are linked to the CPI, having been switched in 2010. But typically pension inflation protection awarded before retirement is linked to CPI. So many schemes provide increases in payments which are linked to RPI, because this is hard-coded, for instance, into the scheme rules, as John touched on. So schemes that are hedging inflation risk hold assets that move in line with RPI, but there are currently a few instruments available to actually hedge CPI inflation. And as was mentioned, about 75% of pension schemes still have some sort of RPI linkage. So given that there's this historic difference on average of about 1% between RPI and CPIH, if we looked at, say, a 65-year-old pensioner with a currently RPI linked pension, they could see quite a significant reduction in their pension income as a result of the change. It could be in the tune of, say, about 10–15%, depending on the circumstances. So now if we move on to the next slide, which sets out a summary of the consultation questions included in the consultation document. So to summarise these, it's essentially the government are asking, is this proposed approach statistically rigorous? what will be the impact on these index-linked gilt holders, the impact on other index-linked gilt in the gilt market, considering the various shortcomings of RPI as we covered earlier, and any other factors that the government should be considering at this time in relation to their decision, and any other guidance. So in terms of the recommendation, taking into account the consultations, the reviews and the inquiries over the last, say, 8 years, the 2 recommendations are really being made in the consultation: that the publication of RPI should stop and should cease, and taking into account that outright abolition of RPI would require legislation, and in the interim, the shortcomings of the RPI should be addressed by bringing the methods and data sources of CPIH into it. And the consultation also considers whether implementation should be at a date other than 2030, when under the legal framework there would no longer be a government role in the process for changes to RPI, and if so, when between 2025 and 2030, with the government not wanting to change before 2025. So I think it's going to be a significant pensions debate over the next few years. So that just brings us on to my final slide. I've just included a link to the consultation with details on how to respond, and I know many companies will be looking to provide a response to the consultation. So thanks for listening, everyone. I hope you found my presentation useful. Happy to take questions at the end of the presentations. And I'll now hand back to Caroline for the next presentation.
Hi everyone, just to let you know, we actually had Kevin Humperson from Deloitte to present next, but I've just literally been on the phone to him. His IT isn't working this morning, so when he joined, he kept getting kicked out, so he will unfortunately not be able to present this morning. So he will present at a later date, probably at either the June or July next webinar. So I think we're just going to head straight on to any questions. So let me just see what questions we have. I'm not seeing any kind of...
There's one, sorry Kaz, there's one right at the bottom there from Judith, if you scroll right to the bottom. Or I can read it out.
Yes, I
seen it here.
Can you see it, Emer? Do you want to read it?
Yeah, so the question from Judith: are we seeing a move to reduce the deduction between RPI and CPI for actuarial valuation purposes? Are you seeing this change as term dependent? I think we're at the beginning of seeing different actuaries consider this move and this allowance for RPI to CPIH. I know in a recent valuation I was involved in, the scheme actuary did decide to reduce the gap between RPI, to reduce the gap to allow for this move between RPI and CPIH, and that was on one example. But I think we're starting to see it being considered for different schemes. But yeah, we are considering it in terms of setting assumptions. Hope that answers the question.
Any more questions at all, either on John's presentation or Emer's? Give people a couple of minutes just to send anything through. I can't see anything coming through directly immediately. No, I can't see anything there. I think if that's it, then given we're not able to have Kevin this morning, I think we'll probably call it a day there. We'd be grateful for any feedback that anybody has, and we will send you a form out after the event. I'd be particularly interested in any technical issues that people have had, and the particular issues if you know what's caused them. I know there's a couple of people that I've been chatting with on the chat forum about it. So we want to run these kind of monthly, so we're keen to iron out any technical issues that people have. If we can do so at our end, I appreciate that some of them may be at your own end on your own IT systems, but anything we can do to help would be grateful to have your feedback on. So thank you very much, everybody. If we end the event there.
Thank you.
Thanks for coming.